Hello and welcome students. In the last video lecture I had explained you question number 17 of chapter number 2, that is final accounts of partnership firm. Now in this video lecture I am going to explain you question number 19, that is the last sum of this chapter. So without wasting much time, let's move on to the calculation of it. That is on page number 87 and 88 of your textbook. As you can see on the board, I have already prepared, that is trading account, P&L account, P&L appropriation account, partners current account, and last, that is the balance sheet and few of the working notes that I have shown at the last. So let us read one by one the entries and do the posting from the trial balance in the concerned accounts. Joint and Prafula partners of a partnership firm sharing profit and loss in equal proportion. There are two partners, Joint and Prafula, and the profit and loss sharing ratio, that is 1:1. From the trial balance dated 31st March, and additional information, prepare financial accounts of the firm. On the basis of the trial balance and the adjustments that are given to you, you have to prepare the final accounts of the partnership firm. Trial balance that is given to you, that first entry that is given capital and drawings of Joint and Prafula. Always you are knowing that is capital will be having a credit balance and drawings that will be having a debit balance. So capital of Joint and Prafula that is given 1,40,000, 1 lakh and 1,40,000. Now students, over here there is current account, also balances are given of both the partners. So we have to prepare partners current account, and the partners capital will remain fixed as it is. It means the opening balance of capital and closing balance of capital will remain as it is, same. So directly you can see the capital of Joint Prafula that are written on the balance sheet after at the end of the year, that is of Joint Prafula 1 lakh and 1,40,000, total in outer column that is 2,40,000. Now the drawings is given to you, that is 12,000 and 16,000. So drawings will be recorded in the partners current account on the debit side. Okay. So debit side here you can see I have done two drawings, that is in column of Joint that is 12,000 and in column of Prafula that is 16,000. Then afterwards current account balance is given, that is of Joint that is debit balance, that is 12,000, and of Prafula that is credit balance 4,000. Okay, so credit balance will be recorded on credit side of partners current account by balance brought down first entry in column of Prafula that is 4,000, and debit balance that is of Joint on the debit side of partners current account, that is to balance brought down in column of Joint that is 12,000. Then afterwards goods stock, that is bracket given first April, so it is opening stock, value is given to you 60,000. So trading account first entry that will be of opening stock to opening stock, that is rupees 60,000. Then afterwards purchase and sale, that is 2 lakh and 3,80,000. Purchase will be having a debit balance. So trading account second entry that will come of purchase. So to purchase 2 lakh in inner column because adjustment is there, and credit side first entry that will be buy sells 3,80,000 in inner column because adjustment of purchase return and sales return is there. Okay. Then afterwards goods return, that is given to you 7,000 and 1,200. Now purchase return will always be having a credit balance and sales return will always be having a debit balance. So you can see I have written over here, that is sales return minus sales return. From sales that will subtract, that is 7,000, and purchase return that I have subtracted from purchase, that is 12,000. Okay, still I have kept the balance in inner column because there is one more adjustment related to both. That's why I have not subtracted and put the value in the outer column. Okay. Next one, that is cash and bank. Cash balance and bank overdraft. One is debit balance given, another one is credit balance. Whatever is credit balance, that will be bank overdraft. Okay. So cash balance that is 3,700, that will be on the asset side of balance sheet. You can see cash that is 3,700, and bank overdraft that is on the liability side of balance sheet 15,750. Then afterwards bills receivable and bills payable. Bills receivable that is debit balance 18,000 and bills payable that is 14,000. So bills receivable that will be on asset side 18,000, and on the liability side bills payable that will be 14,000. Then afterwards rent that is given to you 22,000, that will be debit side of P&L account because it is an expense. Okay. So to rent you can see in the inner column because in the bracket date is given to you. It means there is a hidden adjustment. So inner column are written 22,000. Then afterwards building value that is given to you 1,20,000. Asset side first entry that I have written building 1,20,000 directly in outer column because there is no any depreciation on it. Then afterwards current year's depreciation on building, that is 12,000. Now this depreciation on building that is given in trial balance. So only one effect of this depreciation, that would be on the debit side of P&L account. It will not be subtracted from the concerned assets on the asset side of balance sheet. Okay, so you can see on the P&L account debit side, they have written depreciation on building, that is 12,000. Only one effect of the trial balance. If there is an adjustment, then there will be two effect of any of the adjustments. Then afterwards, freight, that is 5,300. Freight, that is expense related to goods, so it will be recorded on the debit side of trading account. So you can see debit side of trading account has written to freight, that is 5,300. Then afterwards, furniture, that is 84,600. So furniture, that is on the asset side 84,600, that I have written in inner column because there is an adjustment, so 84,600 in inner column. Next one, that is sale of furniture, that is 14,600. That is on 1st April 2016. Now our accounting year, that is for 1st April 2016 to 31st March 2017. Now this sale of furniture that we have done on 1st April 2016, that is 14,600. Okay, so 70,000, that would be the remaining balance. Okay, so 14,600 that we have sold, so the remaining balance, that would be 70,000. Then afterwards, debtors and creditors. Debtors, that is given to you 48,000, and creditors, that is given to you 16,800. So debtors, that would be on the asset side, that is 48,000, and creditors, that would be on the liability side, that is 16,800. Debtors would be inner column because there is an adjustment on it. Then afterwards, salary that is given to you, that is of 20,000, that would be on the debit side of P&L account. To salary in inner column because there is an adjustment on it. So to salary debit side of P&L account 20,000. Then afterwards, insurance premium, that is 5,700. That would be also on the debit side of P&L account 5,700 in inner column because in bracket the date has been given to you. So there is a hidden adjustment on it. Okay, that will solve out later. Then afterwards, bad debts and bad debt reserve. Now bad debts, that is given to you 1,000, and bad debt reserve, that is 2,000. So bad debts, that is of trial balance. So I have written on the debit side of P&L account in bracket I have written TB. It means trial balance 1,000. And bad debt reserve, it is given only in trial balance. No any adjustment related to bad debt reserve is given. That's only one effect of it, that is on the credit side of P&L account. That will be by bad debt reserve, that is 2,000. You can subtract from here also on the debit side, and you can write directly on the credit side of P&L account also. But generally, whenever it is given only in trial balance, we are writing on the credit side of P&L account. Then afterwards, loan of Prafula, that is 20,000. Loan of Prafula, that would be P's loan. You can see I have written on the liability side of balance sheet inner column because we have to count the interest on it, that is 20,000. We have to count the interest that we will calculate later on. Then afterwards, wages, that is, it is written wage, but it is wages. Wages, that is given to you 11,000. So wages, that will be recorded on the debit side of credit account. Two wages, that is 11,000. Then afterwards, discount allowed and discount received. Whatever debit balance that is allowed and whatever credit balance that is received. Okay. So to discount allowed, that is debit side of P&L account 650, and credit side of P&L account by discount received, that is 850. Then afterwards, discount, then after trading expense, that is given to you 1,050, that will be recorded on the debit side of P&L account. To trading expense, that is 1,050. Then afterwards, advertisement expense, that is 8,000, that will also be on the debit side of P&L account. To advertisement expense, that is 8,000. Last effect of trial balance, that is office machines. 52,000, that is given to you. I have written the asset side of balance sheet machine, that is 40,000 in inner column, and addition of 12,000 on 31st December 2016. Now the value that is given to outer column, that is 52,000. Of that 52,000, 12,000 has been added on 31st December 2016. It means in the starting of the year on 1st April 2016, the balance of machine, that was only 40,000. So you can see I have written machine in inner column, that is only 40,000. Plus addition that I have shown, that is 12,000. That addition of new machinery that was done on 31st December 2016. So the new balance at the end of the year, that would be 52,000. Okay, on that we have to count the depreciation. But for 40,000 we have to count for the entire year. But for 12,000 that has been added on 31st December. So we have to count the depreciation for only 3 months, that is January, February and March. Okay. Now after completion of all the entries of the trial balance, we'll look at the adjustments. The first adjustment, that is of closing stock. The value of closing stock that is given to you 60,000. Now out of which the market value of 10% goods is 20% less and the market value of 20% goods is 10% less. The remaining goods of 42,000 is valued at 25% less than book value. Now students, you are knowing very well that closing stock cost on market price, whichever is less, that will be considered. Okay, so whatever the values that are given to you, whatever the decrease in value, that will be considered over here. So I have shown the working note over here. You can see closing stock working note. Total value that is given to you 60,000. Of that 10% of 60,000 that will come 6,000. 20% less, so it will come to 1200. On 6,000 you will come 20%, it will come 1200. In the same way, on 60,000, 20% it would come 12,000. On 12,000, 10% less. So 10% that would come to 1,200. And the remaining that would be 70%. 20 plus 10, 30. So 100 minus 30, that would be 70%. So 60,000, 70% it would come to 42,000. On that 25% less. So it would come 10,500. So we have to consider minus the decrease in the value of the closing stock. So you can see I have written over here 60,000, that is the value of closing stock, minus I have done 12,900. Now how this 12,900 came? That is 1,200 plus 1,200, 2,400, 2,400 plus 10,500, it will come to 12,900. That is the decrease in the value of closing stock that we have to subtract. Okay. So 60,000 minus 12,900. So the actual value of closing stock that will show in the books of accounts, that is 47,100. Okay. So there will be two effects of this adjustment. One on the credit side of trading account, that is last entry by closing stock 47,100, and on the asset side of balance sheet, that is 47,100. Okay. Next, second adjustment, provide 10% interest on capital. There are interest on capital also, interest on current account and interest on drawings. One by one we'll calculate each and every one. First of all, interest on capital. Now interest on capital, for that the adjustment number 4th one. Profula has introduced additional capital of rupees 20,000 on 1st January 2017. Now first of all, let us see what is the balance of capital of Joy and Profula. For Joy, that is 1 lakh. So 1 lakh will come 10%, then it would come to 10,000. So two effects of this interest on capital. One you can see, that is on the debit side of P&L appropriation account, that is to interest on capital for Joy, that is on 1 lakh 10%, that would come to 10,000. But for Profula, we have to count the interest on capital, because the total capital of Profula, that is 1,40,000. But out of that, 20,000, you can see the fourth adjustment, that is 20,000 additional capital that she had brought on 1st January 2017. So on 20,000, we have to count the interest for only 3 months, that is January, February and March. Okay. So for remaining balance, that is 1,20,000. Okay, 1,20,000 we have to count for 10% for the full year, that will come to 12,000, and for 20,000 we have to count for only 3 months, so that will come to 500. So 12,000 plus 500, it will come to 12,500. So your interest on capital for Profula, that is shown to you 12,500. Okay, so it is clear that how to count the interest on capital for whatever the additional capital, when it has been brought. From that date only we have to count the interest on capital on the additional capital, and for the starting of the capital, whatever is there for the entire life. Okay, so in that way the interest on capital for Profula, that will come to 12,500. Total of both this will come 22,500. And the second effect, your debit side of P&L appropriation account and partners current account, it will be on the credit side. So you can see I have written on the credit side of partners current account, that is by interest on capital in column of J 10,000 and in column of Profula, that is 12,500. Then afterwards interest on current account, that is given to you 9%. Okay. Now what is the balance of current account of credit balance, that is of Profula, that is 4,000. 4,000 9% it will come to 360. So you can see I have written by interest on current account, that is in column of Profula 360. And in the same way, that is debit balance of Joy, that is 12,000. So on 12,000 9% would come 1,080. Okay. So So I have written on the debit side interest on current account of J, that is 1080. Now this is an adjustment, so the second effect that would be in the P&L appropriation account. Here I have written debit side, so on P&L appropriation account I have to write credit side. Okay, so you can see I have written the first entry by interest on current account of J, that is 1080, and over here I have written credit side of Prafula. So on the P&L appropriation account it would come debit side, that is to interest on current account of Prafula, that is 360. Okay. Then afterwards interest on drawings, that is at 12%. Now that calculation I have shown it to you. That is of J and Prafula interest on drawings, because there is one adjustment related to it, that is seventh adjustment related to drawings. Prafula has withdrawn goods of rupees 2000 on 1st December 2016, which is recorded in the sales book at rupees 2400. And also one more adjustment is that is 5th and 7th adjustment. We have to refer regarding drawings in order to count the interest on drawings. So first of all, let us refer 5th adjustment. J has withdrawn rupees 1000 per month on the last date of each month. Last date of each month, so students, we have to count for 66 months. So 66 by 12. Every month he is withdrawing rupees 1000. So how to calculate the interest on drawings for J? That is 1000 multiplied by 12, that is 12% rate of interest upon 100 into 66 by 12 at the end of every month. So 66 by 12. Students already have understood this in the chapter number 1. That is at the end of every month, then we have to count 66 by 12. Okay. So it would come the interest on drawings for J, that is 660. Now in case of Prafula, that is 16,000 is the total amount of drawings. As you can see, I have written the drawings for Prafula, that is 16,000. Now in that 16,000, seventh adjustment you have to refer together with that. That is Prafula has withdrawn goods of 2,000 on 1st December. So 16,000 that is cash withdrawn and 2,000 that is goods withdrawn on 1st December. So we have to count the interest on drawings on 2,000 for 4 months also. That is goods withdrawn. Okay. So for 16,000 will count for 12%. That is for 6 months. See, it has been mentioned over there. That is Prafula has introduced additional. Prafula has withdrawn on 1st October 2016. That is 5th adjustment. It means whatever that she has withdrawn 16,000, that is on 1st October 2016. It means for 6 months. 10, 11, 12, 1, 2 and 3. For 6 months you have to count on 16,000 at 12% rate of interest. It would come to 960. And for 2,000 that goods she has withdrawn, on that we have to count at 12% for 4 months, because she has withdrawn on 1st December. So for 4 months it would come to 80 rupees. So total interest on drawings for Prafula, it would come 960 plus 80. So it would come to 1,040. You can see I have written on the credit side of P&L appropriation account, that is by interest on drawings for J, that is 660, and for Prafula that is 1,040. Total in outer column, that is 1,700. In the same way, we have to do the second entry in the partner's current account on the debit side. You can see I have written two interest on drawings, that is for J 660 and for Prafula that is 1,040. Okay. Now after completing of the interest on capital, interest on drawings and interest on current account, let us see the third adjustment. Monthly salary of rupees 700 is payable to J. He has withdrawn salary of 4 months, which is included in salary. Now monthly salary of rupees 700 is payable to J. So for 1 month if it is 700, then for 12 months it would be 8,400. That is payable to J. Okay, so you can see in partner's current account I have written credit side by salary in the column of J. Then bracket also I have shown 700 into 12, that is 8,400. And the second entry that would be on the P&L appropriation account debit side. Okay, so debit side of P&L appropriation account I have written two salary, that is 8,400 to J. Okay, now there is one more effect of it. Read the third adjustment, that is he has withdrawn salary of 4 months, which is included in salary. Now out of this 12-month salary, he has withdrawn salary of 4 months. So for 1 month it is 700, and for 4 months it would be 2,800. That he has withdrawn and that is included in salary. Okay, so we have to subtract from salary, because that salary is particularly of any of the partner. Okay, so we have to subtract from the salary. You can see two salary are written in the inner column, that is 20,000 minus salary of J, that is for 4 months 2,800. Outer column that would come to 17,200. Now that salary he has withdrawn in cash. So the second effect that would come in the debit side of partners current account, that is to salary brackets he have written cash over here because that much amount of cash he has withdrawn in the form of salary, that is for 4 months. Okay, so I have written in the column of J, that is 2800. So ultimately there are 4 effects there will be of this transaction. Again I am repeating the transaction. First of all, that is salary of J, that is 2800, 4 months salary has been withdrawn, but by mistake it has been included in salary, so it will be subtracted from salary. And the second effect of this that will be on the debit side of partners current account. And the actual salary, that is of 12 months, so for 12 months it would come to 8400. So for 8400, to salary 8400. So here it would be to salary 8400, and the simultaneous effect of that salary, that is 8400, that would be on the credit side of partners current account in the column of J, that is 8400. So 4 effect would be there of salary. Now after completing third adjustment, let us see the fourth adjustment. Prafula has introduced additional capital of 20,000 on 1st January 2017. Already we have understood this additional capital, and we have found the interest on capital also on this additional capital. Okay. Then afterwards, J has withdrawn rupees 1,000 per month on the last date of each month. Prafula has withdrawn on 1st October. That also we have done calculated while counting the interest on drawings. Okay. Then afterwards, sixth adjustment, calculate depreciation at 9% on machines and 5% on furniture. 9% on machines. Now you can see in machines, that is 40,000 plus addition, that is 12,000. So 9% depreciation, first of all on 40,000, that would come to 3,600, that is for the entire year. And for 12,000, that would be for only 3 months. That is machinery given to you value. Machinery last adjustment, that is given to addition of 12,000, that is on 31st December. So for on 12,000 you have to count 9% depreciation for only 3 months. It would come to 270. Okay, so 3,600 plus 270, total depreciation of machinery, that would come 3,870. Subtracting it, outer column you have to place 48,130. Okay, and the next effect of this depreciation, that will be on the debit side of P&L account, to depreciation on machinery, that is 3,870. Okay, so addition of machinery, the date is given, so you have to count the depreciation at the time that machinery you have purchased. So on 40,000 you will count depreciation for the entire year, and for 12,000 you will count depreciation for only 3 months, that is January, February and March. Okay. Now after completing depreciation on machinery, let us go on 5% depreciation on furniture. So on depreciation on furniture, that is 84,600, from that sales that was done on 14,600. Date is given by mistake over here, that is 1st April, it is actually 1st October. Okay. So pay attention, on 70,000 we will count depreciation at 5% for the entire year, then it will come to 3,500. And for 14,600 for 6 months at 5%, then we will get, that is 365. Okay, so 3,500 plus 365, total it will come to 3,865. So in outer column, after subtracting the value, that will come 66,135. And the second effect of this depreciation on furniture, that would be on the debit side of P&L account. So you can see two depreciation on furniture, that is 3,865. Okay. Now after completion sixth adjustment, seventh one, that is Prafula has withdrawn goods of 2,000 on 1st December 2016, which is recorded in sales book at 2,400. Now goods withdrawn, that is for personal use. Okay, so goods withdrawn for personal use, so we have to subtract from the purchase. Here you can see I have written minus drawings, that is 2,000, that is goods withdrawn by Prafula for personal use. So after subtracting 2 lakh minus 12 plus 2 means 14. So 2 lakh minus 14,000, outer column has placed 1,86,000. Now this drawings that he has withdrawn 2,000, that second effect that would be on the debit side of partners current account. Two drawings in bracket are written goods because there are goods withdrawn in the column of Prafula, that is 2,000. So two effect of this goods withdrawn for personal use. which is recorded in sales book. Now the wrong mistake has been done, that is it is by mistake recorded in sales book at rupees 2,400. So we have to subtract from sales book because it is goods withdrawn for personal use. By mistake it is recorded in sales book. So we have to subtract it from sales. So you can see I written minus drawings, that is 2,400. So from 3,18,000 I will subtract these two values. Outer column it will come 3,70,600. If I have subtracted from sales, I have to subtract from debtors also. Okay, because sales and debtors have direct relation. So debtors, that is wrong value 2,400 that I have subtract. Outer column, inner column only, that will come 45,600. Okay. Now the last adjustment that is remaining, one debtor of 2,400 became insolvent and 40 paise per rupee dividend is receivable. So for 2,400, 40 paise is receivable. It means 40% amount is receivable. So 60% amount that would be bad debts. So on 2,400, 60% that would be 1,440. Okay. So that would be considered as bad debts. 40% is receivable. So 60% is not recoverable. Okay. So that would be considered as bad debts. So we have to subtract 45,600 balance was there of debtors. From that we subtract bad debts, that is 1,440. Now the column will become 44,160. And the second effect of this bad debts, that would be on the debit side of P&L account. We have written bad debts of trial balance in inner column plus bad debts of adjustment that we have just now found out, that is 1,440. Total that will come 2,440 outer column. Okay. Now all the adjustments effect that we have completed. Now we have to look at the hidden adjustment. There are few of the hidden adjustments. So let us look at it. First one, that is rent, in bracket is given up to February 2017, that is 22,000. Our accounting year that is ending on March 31st March 2017. So for 1 year, 1 month rent that is outstanding. For 11 months that is 22,000. For 11 months that is 22,000. For 1 month it will come to 2,000. Okay. So you will write over here plus outstanding rent that is 2,000. In outer column you will write 24,000. And the second effect of it that would be on the liability side of balance sheet. So you can see liability side I have written outstanding rent that is 2,000. Okay. Then afterwards sale of furniture that we have done. Then after insurance premium. Now in bracket it is given to you including rupees 3,600 for the year ending on 30th June 2017. Our accounting year that is 31st March 2017. Over here it is ending on 30th June. So extra 3 months insurance premium that we have paid in advance, that is prepaid insurance premium. For 12 months it is 3,600. Then for 3 months it would be 900. It means 3,600 divided by 4, it would come to 900. So that you have to subtract from insurance premium on the debit side of P&L account, that is minus prepaid insurance, that is 900. Outer column it will come to 4,800. And the second effect of it that would be on the asset side of balance sheet, that is prepaid insurance premium, that is 900. Students, don't forget while giving the effect of adjustment, both the effects should be given simultaneously so that you don't forget any of the entries. Okay. Then afterwards insurance premium, then afterwards loan of Profula. That is date is given to you and you are going the interest on partner's loan, that is at 6%. So on 20,000 at 6% it will come 1,200. But over here we have to count interest for only 6 months. So it will come to 600. So you can see written plus outstanding interest on loan, that is 600. Total in outer column that is 20,600. And the second effect of this outstanding interest that will be on the debit side of P&L account, that is 2 outstanding interest on loan 600. Okay. So all the adjustment and even the hidden adjustments that we have completed. Now nowhere any of the adjustments or trial balance effect is remaining. Now one by one we close all the accounts. You can see on the credit side total is more, that is coming 4,17,700. Both the side have placed. Difference that is coming on debit side, that is gross profit. Here I have written question mark to show that this value I have found out. Okay. So difference that is gross profit 1,55,400. That I have written on the credit side of the P&L account, that is by gross profit 1,55,400. Total of the credit side of P&L account, that is 1,58,250. Both the side have placed. Difference that would be net profit. Net profit after subtracting all the debit effects, that would come 79,775. That will be placed in the P&L appropriation account. So P&L appropriation account, you can see credit side I have written by net profit, that is 79,775. So total of credit side that will come 82,555. Both the side have placed difference of P&L appropriation account that will be considered as divisible profit that will be distributed amongst the partners in their profit and loss sharing ratio. Here it is 1:1. Okay, so 51,295 that is distributed in 1:1 ratio. Then came for Joy and Profula, that is it was coming in point. So here I have placed one more and here one less. Okay, so 25,648 and 25,647. Instead of putting it in decimal, that is 0.5. I have written 25,648 and 25,647. Now this divisible profit that will be transferred to partners' current account, that is on credit side. Okay, so here you can see I have written by P&L appropriation account 25,648 and 25,647. Sorry, over here it will come 25,647 for profit. Okay, so that will be transferred the divisible profit. Now we have to close the partners' current account. In partners' current account, the total of credit side is more for both. So it would come the credit balance of current account. Total of Joy that is coming 44,048 and for Profula that is coming 42,507. Both the total I have put over here. Difference that is coming, that is the closing balance of partners' current account. For Joy it is coming 15,508 and for Profula that is coming 23,467. Both these closing balance, it is credit balance because difference is coming on debit side. Total of credit side is more, so the balance will be credit balance. So credit balance that will be recorded on the liability side of balance sheet. Here you can see for Joy and Profula that is 15,508 and 23,467. Total in outer column 38,970. Okay. So now after completion of all the entries and closing all the accounts, last we have to close the balance sheet. Here you can see the total of both the sides should come equal, and it is coming equal, that is 3,48,125, 3,48,125. That is the total of liability and asset side of balance sheet. It means the balance sheet gets tallied. Students, if the balance sheet gets tallied, it means your answer is correct. So that's all for today, students, and today is the end of this chapter. Do revise this sum again by revising the video lecture because that is very important sum. Maximum of the adjustments and the maximum of the transactions are covered in this sum. So refer it again. Till then, goodbye. Keep practicing. Stay.